Greetings and welcome to the August 2025 Investment Strategy Brief. Sometimes in August we take the month off, but I wanted to continue the discussion from last month where we talked about our second half outlook. We've been talking about headwinds as well as tailwinds and the idea in some ways of crosswinds being formed, but ultimately it's about this sort of struggle between the resilience of the environment and risks that we're seeing. So let's jump in. We've talked a bit about geopolitics, and we're going to talk about the market remaining pretty resilient. But when it comes to geopolitics, obviously this identifies risks that could serve as a headwind, in a way, a catalyst for maybe some negative moves in the market. And one of those things, of course, is the Israel-Iran conflict, which has settled down. But, what people are watching in these military hotspots, potential for that is for things to re-escalate. And, of course, the discussions around peace in Ukraine are in focus. So all these things are obviously problematic. In the case of the Middle East, that can be about oil, but also it's just an animal spirits thing. People can get sort of worried or down about it, and that can slow things down a little bit. So again, that's something that's in focus as a potential headwind. And then when we look into DC, as we've talked about for the balance of the year, really, lots of big shifts happening, as we know. And as we talked about last time, one of the latest things was this idea of the spending bill, which generally speaking has been stimulative. So even though there's been a lot of tariff uncertainty, and we'll get into some sort of potentially resurging inflation, the market's sort of seen through that to the sort of the positives of the environment. I think that includes essentially deals when it comes to trade and tariffs, as well as the stimulative effects of the spending bill. So again, in some ways, the tariff uncertainty is a headwind. But the clarity that's becoming better known, as well as the stimulative effect of the spending bill, are sort of tailwinds in the current environment. Now, turning to the economy more broadly, we know that there's been, generally speaking, a return to trend growth after the shutdown and reopening of the pandemic. We were reminded, as ever, that the consumer represents about 2/3 of the economy. So how the consumer is doing is super important. Recently, and we've talked a bit over time about retail sales bouncing around somewhere between 0 and positive numbers. We just got a recent print, basically another positive move, 0.5% up, I think, round numbers, month over month in terms of retail sales. So generally speaking, the consumer remaining engaged despite some softening confidence and sentiment. And there's been talk about looking for cracks in the labor market. Obviously, that relates to a good degree to the consumer. So last month, in fact, we looked at this chart, but I've updated it just a little bit. Reminder that the gray bars represent the averages pre-pandemic. The green bar represents the data from the reopening from the pandemic, and then the blue is the most recent print. So we've seen unemployment, as defined by the unemployment rate, a little better than normal. We see that a little bit in terms of jobless claims, that data generally hovering at a place better than what we've seen in those two periods just mentioned. The JOLTS report is showing job openings still remaining robust, but a crack, if you will, was a non-farm payroll report that was softer than expected, softer than that long-term average pre-pandemic, and then also some revisions to a couple months prior that all kind of focus on the potential for a softening job market, but that's against the backdrop, again, of things being pretty firm. And so I don't think anybody's raising significant alarms, but we know this is something that's in focus for the Fed. In any event, all this is translating to the view that we're going to have positive growth this year, the consensus forecast being at 1.5%, down a little bit from the beginning of the year when it was at 2.1%. But everybody's watching for, these shifts, these factors to have an impact, right? Tariff uncertainty being a good example of that as one of the headwinds. In any event, let's turn to inflation. And, for those that watch the news and whatnot, we saw an unexpectedly large report, a large print for the producer price index for July, basically at 0.9%. That number is way out of sort of normal pattern here. Of course, immediately folks were focused in on whether or not that relates or how much it relates to tariffs. But as it relates to this exhibit, you can see that we'd seen things calming down. But even with that 0.9, then looking at our 3-month rolling average for the producer price index now running just a little bit about double the Fed's 2% target, that green line. And so the punchline here is that that one print has everybody focused on whether inflation is resurging a little bit. And in fact, when we look at Fed funds futures, prior to that report, basically we had gotten to a point where the market was pricing in 3/4 point cuts from the Fed this year, and that's rolled back again to 2 cuts. And so, it's, I think, at around a 95% probability that the Fed will act in September with a 1/4 point cut, and then potentially another one later in the year. But that worry about inflation, right, and the potential for tariff effects is in keen focus, and therefore people are a little bit less optimistic, if you will, that the Fed will really cut rates aggressively. Again, we'll see how things unfold. Now, obviously, we've talked a lot about the idea that rates remain elevated and will likely stay so. That, against the backdrop of a lot of debt, especially in the government, means that, in our view, this is something that is important. It's important to bring it into focus. We've seen government leaders and corporate leaders talk about that. Not as much action as I think any of us would like to see in terms of reining in the budget overall. And so that'll be something we'll keep an eye on in terms of the future here. Now, turning to the markets, we've talked a lot about elevated interest rates. As an investor, that's good, right? With the idea that we can put money to work in the bond market. So across all the various sectors of the bond market, as we've talked about before, basically we're seeing levels of yields, if you will, on all kinds of different bond categories remain elevated. So as investors looking forward, that's very appealing. We've seen actually a calming in what's called the MOVE index, which is a measure of volatility. So volatility in the bond market has come down just a little bit, which is good. Then turning to stocks, essentially, as we've talked about before, we've had this chart again as the first year of a presidential term. The blue line, the long-term average, the orange line, Trump's first term, and then the gray line, the journey we've been on this year. And you can see that big move down with Liberation Day and tariff uncertainty, and then the climb back, given a little bit more clarity on tariffs, given the spending bill, given corporate earnings, corporate profits holding up so far. All of this has been, reasonably positive for stocks. And that orange line, just to remind you, is the level at which we expected the market to close the year. It actually hit that level right at June 30th. So it led to us in the last episode given a new soft target. That was a 6,200 target. We've revised that to 6,500. And so anyway, as we move forward here, we're going to watch the market, and I want to talk and sort of reiterate where we are relative to that 6,500 target. In any event, as it relates to valuation levels, and you can see basically we're getting pretty close to that 6,500. What that means is on a PE ratio basis, on a cap-weighted basis, the market is actually approaching 25% overvalued when we look at the price-earnings ratio compared to its 10-year history. When we equal weight that, the numbers are a lot more muted. The market's more fairly valued. So it gets into that whole idea that the bigger tech-oriented companies in particular are driving PE ratios a bit higher. And in fact, in this session, I wanted to just tease out that sector effect. And so here's a chart that shows the weight, the profit margin, trailing price earnings ratio, long-term earnings growth, and then a PEG ratio. That's a ratio that normalizes the PE ratio for growth. And what you can see is that overall, again, the PE ratio on the S&P 500, round numbers, about 27, with a long-term growth rate of 9.5. That translates to a PEG ratio of 2.9. Interestingly, when you look at technology, information technology, PE at 42, but the growth rate, long-term estimates at 16.3%. And so that's a PEG ratio of 2.6. So notably, the tech sector isn't the most richly valued on a PEG ratio basis, right? And so again, I think that the takeaway here is that markets are a bit overvalued, but there's an opportunity in any event when we look at diversification to find value in the market. Now, as it relates to the behavior of the market, one shift that occurred back in April, there was a lot of negativity in the environment given the uncertainty of tariffs, and that got baked into forecast on earnings. So you can see in April a big orange bar. That's the negative revisions to earnings. That sort of flipped around as we've gotten to August, a little bit to undo some of those negative views, but also just a generally more positive environment, right? So more positive revisions in the current environment, which again is just supportive of equity market levels. So all in all, as it relates to the equity market, I would just say that, we're mindful that things have moved pretty quickly. We're not that far from this revised year-end target of 6,500. All the things we've been talking about, to the degree that there's disappointment, we'll get into this, there could be a downward move, but our base case is for things to hold up and move a little higher. In any event, I want to spend a moment on some of the positivity in the environment related to things like artificial intelligence. We tend to think of this more broadly, in a more general way, really around our long-term investment themes, which we've talked a lot about, moving from right to left, the productive competition concept, the idea that things like U.S.-China competition makes both parties fight harder, makes us both better at what we do. You can actually say that about company competition as well. We've got the new consumer basically understanding how consumption gets done and preferences, if you will. Those preferences are also influenced by shifting demographics, the idea of there being longevity, the idea of the next generation kind of taking over and what their preferences are. We know there's a focus on securing strategic resources, things like energy, food, and water, and what are the innovations around that. And then the fourth industrial revolution, which is really around technology innovation, kind of blurring the lines between the digital and physical worlds, for example. And yet part of that is artificial intelligence, but honestly, artificial intelligence is sort of affecting everything across all the themes that we have. And I did include just a quick sort of snapshot of a 3-page article that we first produced for our Outlook report. We've since published it independently, but the whole idea is just to sort of have some fun with where we might see the world in a decade, right? And some things that are in focus as it relates to innovation. And so I'll ask you to kind of check that out. In any event, getting back to the market, so think of it as that AI optimism is holding things up as well. There's so much investment, so much change, and honestly still low levels of adoption, so more adoption to come, more innovation, more efficiency to come around that, and that's kind of holding up the equity markets. Many of the categories have since recovered from the lows of the sort of the scare in April. And of course, over the last year, the markets have produced, generally speaking, very positive returns. And so, again, I think the takeaway here is markets have been much more positive, certainly than people might have anticipated back in April. And just to sort of recap again, sort of the foundations for that idea of the current levels are getting, let's say to 6,500 by the end of the year. That I've talked a little bit about this, a little bit more clarity on tariffs. There's still uncertainty for sure, but just people understanding the process a little bit. Now, this has become a little more questionable, but inflation being contained, a solid labor market, which we've talked about, the Fed cutting rates at least once or twice, that idea of sort of lower but positive growth, and then earnings holding up. All of those are the factors we consider as we sort of offer up that new soft target of 6,500. And again, as I record this, we're not that far from it. In any event, I did want to reiterate the risks, right? There's policy uncertainty, tariff uncertainty. If there's major shifts or changes from DC that people aren't anticipating, that could be problematic. Obviously, if we see more evidence of inflation reaccelerating, people are going to get spooked by that. If all of that leads to the consumer backing off, remember 2/3 of the economy, that's quite significant. Or if we have another, military event, unexpected geopolitical event, that could be very problematic. So almost like think about it as our base case being positive, modestly positive, but with a recognition of sort of outsized risks compared to normal, any one of which could move the markets lower. So we're kind of guiding people to understand that positive view, but also the potential for some negative moves. And again, sometimes it's an event, but sometimes it's just this sort of eroding sense of optimism and the idea of animal spirits kind of weakening. And so again, this is the kind of thing we're keeping an eye on. So again, often we don't do an August investment strategy brief, but we thought we'd do it just to update this conversation. So thanks so much for taking time today to watch this video, and we'll catch you after the holiday, sort of the sprint to the end of the year. Thanks so much.